Hi, everyone. Welcome to this week's market update. I'm here with Eric Anderson. Eric, markets are ending October on a surprisingly upbeat note. Amazon and Apple both crushed expectations, and the tone globally feels more settled. Let's start in the US. Tech is still doing the heavy lifting, isn't it?
Yes, it really is. The big story this week was Amazon, up over 10% after hours, an enormous move for a trillion-dollar company. Revenue jumped 13% year on year to around $180 billion. But what really impressed investors was the rebound in AWS. Cloud growth accelerated past 20%, margins surged, and cost discipline was evident everywhere. Apple also reminded everyone why it's still a market anchor. Revenues above $100 billion, record iPhone and services sales, and even though China remains a soft spot, the narrative has shifted from worry to resilience. Together, these results reaffirm a simple truth: tech still delivers. Despite all the talk of regulation, tariffs, and saturation, these two companies continue to define the market's tone. And frankly, it's optimism.
So it feels like investors are happy to pay up again for growth that actually earns its keep.
Exactly. What's notable is that AI is no longer a buzzword. It's a business line. AWS, Azure, and Apple's ecosystem are all monetizing AI at scale, and that's where the differentiation lies. It's not speculative anymore. It's profitable.
Let's turn to Japan. The Bank of Japan met this week and kept rates unchanged, but Governor Ueda sounded more cautious. What's the signal there?
The BOJ is walking a very fine line. The policy rate stayed at 0.5%, but the messaging was clear. Don't expect another hike before January. Ueda spoke at length about watching wage settlements, price trends, and global risks. In other words, patience before progress. The market had half expected a move in December, so the yen weakened further, and Japanese equities rallied again. The subtext here is political. The central bank is aligning itself with the government's reflation narrative. A weaker yen supports exports and corporate profits, and for now, that's being tolerated. But there's a risk. By lagging inflation and wages, the BOJ may be falling behind the curve. If the yen drops too sharply and sparks domestic backlash, particularly over import costs, we could see intervention or a policy tweak earlier than expected.
So short term, weaker yen. Medium term, more pressure for the BOJ to act?
That's right. For investors, it means yen bonds stay vulnerable, but equities keep benefiting from ultra-loose policy. Japan's stock market is thriving on liquidity and political clarity, not a bad mix.
Europe's central bank also met. Christine Lagarde kept the ECB on hold. Is that just steady as she goes?
Pretty much. The deposit rate remains at 2.0%, the third straight meeting with no change. Lagarde sounded balanced. Inflation is stabilizing. Growth is weak, but improving slightly, and there's no urgency to move in either direction. Unemployment in the Eurozone is at 6.3%. Sentiment indicators are ticking up, and the ECB seems content to watch and wait. Rate cuts are off the table for now, but so are hikes. That's actually a healthy backdrop for European assets. Not exciting, but stable.
So Japan is loose by design, Europe is steady by default. How does that play through the currencies?
The yen could weaken further near term. The euro's likely range-bound. If anything, a stronger euro might hurt exporters a bit, but it also tells us investors are regaining confidence in Europe's stability.
Let's move to emerging markets. You've been tracking EM capital flows closely. What's the latest there?
Yes, it's actually one of the more underappreciated stories this quarter. EM capital inflows have picked up quite sharply. The third quarter could be the strongest since late 2023. Most of the money has gone into hard currency debt, both sovereign and corporate, as investors search for yield with a bit more confidence. Local currency flows have lagged a bit, which tells you investors are still cautious on FX risk. The big takeaway is that capital's coming back to EM, but it's selective, disciplined, not exuberant.
That's it for this week. Stay tuned for more insights next time.